All right, hello everyone. So as I promised, I was going to send you a video on Tuesday, but I couldn't send it because I was a little down and I'm really sorry about that. So I'm still not feeling well, but I don't want to I don't want to keep yeah, how do I say it? I don't want to wait like a very long time. I want to keep like the momentum of the lesson going. Yeah, so we would continue. So we'll continue from where we left off. We've not like really started with what we are looking at. So first of all, we started with how to use MT4, MT5. We looked at trading view and a little introduction of the kind of stuff that you can trade. So today we are going to dive deep into Forex, right? So we'll look at Forex. So Forex will be the first thing that we will look at. And when we look at Forex, we're going to look at all the like a lot of different things that you can make. When we are looking at Forex, we are going to look at how you can trade Forex. And in that case, we are going to look at how to analyze the market and make a trade and all that. But the process you go through to analyze the market to trade Forex, that's the same way you do for stocks, indices, and crypto and everything. So what I basically mean is we're going to use Forex as the main case study, but everything that we learn is going to be applied to the other things that you can trade. But then when we are done, there will be a separate lesson where I will take you through volatility, because like there is a little slight differences between how you approach volatility and Forex. Sorry, my voice is not really clear. Like, I still cannot really speak well. All right, so let's dive right deep into it. So I'll try and make this lesson a little longer so that you can keep yourself occupied, because after this lesson, I don't know when I can be able to like record another lesson. Like I'm seriously like down at the moment. Like, so I'll try and make this lesson a little longer. And because of that, I'll speak a little faster to make sure I cover like a lot of stuff. So I know some of you are already trading, and this might be like a little boring, but then we'll get to a point where you can catch along, right? So if you're already trading, that is fine. That could be a revision for you. So what is a Forex? Forex comes from foreign currency. So when we Forex stands for foreign currency. Focus on this computer. Forex comes from foreign currency. So when we say Forex trading, it means trading means exchange. So when you are trading anything, if you are trading, like you say like you are into trading, it means you're exchanging goods for money, or you're exchanging goods for goods, or whatever the exchange you are doing. So trading means you are doing an exchange. Exchange, right? So it means that we are doing Forex trading. You're doing what? Exchanging foreign currency. So yeah, you have one currency and you exchange it for the other. So we have a lot of currencies, then we exchange it for another one. So in this lesson, I'm going to go a little different from the way I go about my other lesson. I'll be a little fast. I'll cut down a little part of it to make things a little fast. As I said, anytime you watch the video and you have difficulty understanding, you can hit me personally or on the page, or whichever one is okay for you. You can use whichever means that is okay for you. So the currencies that you can trade, we have 8 main currencies that you can trade. So we have USA, Canada, Australia, New Zealand, Japan, Switzerland, always get stuck somewhere. Right, so we have Europe, and then Britain or the United Kingdom. So these are the countries that we trade their currency. So I will later come and look at the subcategorization of these currencies. We look at how we subcategorize this. As I said, I'm taking a little different approach to how I would normally go about it. So these countries have individual currencies that they trade, and every currency is represented with 3 capital letters. Every currency is represented with 3 capital letters. Every currency is represented with 3 capital letters. So we'll go over them right now. So US, they spend the US dollar. US dollar. This is represented as USD. So this is how it is represented in the market. Anytime you see USD, means you're referring to the US dollar. Canada spends the Canadian dollar. It is represented as CAD. Australia spends the Australian dollar, which is represented as AUD. New Zealand spends the New Zealand dollar, which is represented as NZD. Japan spends the Japanese yen, which is represented as JPY. And then we have Switzerland. They spend the Swiss franc, which is represented as CHF. And then we have Europe. So Europe is all the European countries. They all spend one currency. So the European countries like Norway, Poland, and all those other, Germany and all the other European countries. So they spend the euro, and this is represented by EUR. And then finally we have Britain, and they spend the Great British pound, represented as GBP. So these are the 8 major countries that we exchange their foreign currencies, that we exchange their currency. So I would explain this. I'm taking a little different approach, so I'll come back and explain everything. So there are other currencies that we trade, but they are not part of these main 8 currencies. These currencies, we call them the exotic currencies. Exotic means something that is not common or rare, right? Some of these countries that we trade their currency, but it's not part of these main 8 countries. We have South Africa. They spend the South African rand, but I've just made it rand, and it is represented as ZAR. We have Holland. They spend the Polish lira, represented as POL, POL. We have Singapore. They spend the Singapore dollar. So they also spend a dollar, but that is the Singapore dollar, which is represented as SGD. And then we have how do you call it? Mexico. They spend the Mexican peso, which is represented as MXN. And then we have Turkey. They spend the Turkish lira, which is represented by TRY. Oh, is there any other one I'm forgetting? So we have China. China is also one of them. We have the Chinese yen, which is represented as CHN. Right. So these currencies are referred to as exotic currencies because they are rare. Like rare means they are not commonly traded. They are not a commonly traded currency. So these currencies, US, Canada, and the 8 points, they are commonly traded. These ones are not commonly traded. So we call them the rare currencies or the exotic currencies. Right. But the currencies are not traded individually. You cannot just trade a US dollar. So those of you like, I don't know the geographical location or the geographical location of the people in the group, but I know like most of you are in Ghana and in Nigeria. So you see, in Ghana and Nigeria, we do business with a whole lot of other countries, but then you see, mostly the Ghana cedi and the Nigerian naira is compared to the US dollar. So every currency is traded with another currency. So there's always two currencies that are being compared at every point in time. So for these exotic currencies, so the Ghana cedi and the Nigerian naira, all those currencies would qualify to be under this category, the rare currency, but we are talking about the ones that are actually available for you to trade. So these are also rare currencies, but they are available on the market for you to trade. But the Ghana cedi and the naira, they are also rare or exotic currencies, but they are not available on the market for you to trade. So these currencies are traded in pairs. What it means is that they are paired with the US dollar, the exotic currency. So you have them in this form. So you have USD ZAR representing the US dollar and the South African rand. You have US dollar POL representing US dollar and the Polish lira. You have US dollar SGD representing the US dollar and the Singapore dollar. You have US dollar and MXN, USD MXN representing US dollar and the Mexican peso, US dollar TRY, US dollar and the Turkish lira, US dollar and the Chinese yen. So these are what we call currency pairs. So these currencies are traded in pairs. So with the exotic currencies, they are straightforward. You just pair them with US dollar, and the US dollar will be the first currency, and the other currencies will be the second currency. So later you would understand why it's important when the currency is first and where it's first or second. So for these main currencies, you don't have one currency paired against like all the currencies. All the currencies, the 8 currency countries that we have here, their currencies can be traded or paired against all of them. What this means is that you can take the US dollar and pair it against the Canadian dollar. You can take it and pair it against the Australian dollar, pair it against the New Zealand, pair it with Japan, pair it with the Swiss franc, pair it with the euro, and pair it with the British pound as well. So you can pair them against each other. You can take Canadian dollar, pair it against this, that, like that. But the pairing is not just done. When I say the pairing is not just done, we have a very specific way of doing the pairing. So there are certain currencies that can always be the first currency. So this brings us to the first and second. So as I said earlier, every currency is represented by 3 capital letters, so like AAA. But the currency, for the currency to be traded, it needs to be traded with another currency. So together you have 6 currencies. So you have AAA, let's say AAA, BBB. So you have 3 capital letters for one currency and 3 capital letters for another currency. For another example is US dollar, Canadian dollar. So you have 3 capital letters for the US dollar and 3 capital letters for the Canadian dollar. So before we go into that and do the pairing, let's go back and do what I should have started with initially before we started. So when you are trading currencies, let's look at these as the 2 currencies that you are trading, A and B. So A is representing a currency that has 3 capital letters. B is also representing a currency that has 3 capital letters. So these 2 currencies, A and B, they're always fighting against each other. So for example, if we take the CD and the dollar, they are fighting against each other. So if the CD becomes stronger than the dollar, then the CD will take advantage. If the dollar becomes stronger than the CD, the dollar will take an advantage. So that is how it works. So at every point in time, these 2 currencies are fighting against each other. And at every point in time, it's doing like this. But if one is weak, then the other one will take advantage of the other and keep on pushing in that direction. But under normal circumstances, especially for the very major currencies, like if you take the dollar, the euro, and the euro might go stronger, the dollar will come and overtake it. Like it will just be doing like that. So, but when we say that, we don't say it in terms of the rates, as in if for example, this is one thing that most of my students get confused. So, for example, I don't know what the CD is currently doing. It's being rubbish, but let's not talk about that one. Let's say $1 is equal to 6.5. $1 is equal to 6.5 CDs. Let's take it like that. Let me write it in a different way. US dollar. Right now it's like 7 or something. But let's say 6.5. So from what we are saying, it does not mean that because the $1 is equal to 6.5 Ghana cedi, it means the dollar is stronger than the Ghana cedi. What we are interested in is if right now the dollar becomes stronger from 6.5, let's say it moves from 6.5 and it goes to, so anytime this number becomes smaller, it means that, so here, let me take my time and explain this. I would explain it pop-up. I just want you to have an overview before we go into it. So if you have $1 giving us 6.5 Ghana cedi, it means that if you want $1, you need 6.5 Ghana cedi before you can get $1. So if this value moves from 6.5 to, let's say, 6.1, it means that now you require less CDs to get the same $1, which means at this point in time, the CD has become stronger. So that is what we say when we say a currency has become stronger. It doesn't mean that now the CD has become more valuable than the dollar. What we mean is that within this period that we are talking about, the CD has gained value from 6.5 and now it is 6.1. And if it moves from 6.5 to, let's say, 6.9, it means that now you require more CD to get $1. So we say what? The dollar rather has become stronger because the value has become bigger. I hope this makes sense. As I said, if you don't understand anything, note your question and then we'll discuss it. So let's go back to our initial discussion. Right. So every point in time, there are two currencies that you are comparing against each other, A and B. So you have A being the first currency and B being the second currency, just like we have here. But anytime you are trading them, it is no more A and B. You are trading them as A, B. They are together traded as A, B. But then you need to recognize that there is A component and then the B component. Even though you are trading them as A, B, you need to recognize that there is an A part that came together to form a B part. So for example, you have the US dollar and then the Canadian dollar, but together they form the USD CAD. Right? These are two currencies that came together to form USD CAD. But you need to recognize that there is that USD portion and then the Canadian dollar portion. Right? So what happens is the role of this currency, the first currency, the A, is to move AB up. So anytime AB is pushing up, when we say it's pushing up, we mean the rate, right? So I'll give you an example. Anytime AB is pushing up, it means A is the one causing it, or A is the one causing it. Anytime AB is pushing down, it means B is the one causing it. So any up movement of AB is caused by A. Any down movement of AB is caused by B. So let me give you an example. So USD GHS, that is dollar to Ghana cedi, is what? 6.5 from the example that we are giving. So what we are saying is that anytime this value moves from, if it goes down, if this 6.5 goes down, if this 6.5 goes down to, let's say 5.2, what we are saying is that is the second currency, which is the Ghana cedi, that has become stronger, not the dollar, right? And if it means that this, so this 6.5 is representing the exchange rate of these two, US dollar, Ghana cedi, not just Ghana cedi, not just dollar. So anytime this goes down, we say the market. So the 6.5 is representing the market of USD Ghana cedis. So anytime this goes down, we say the market has gone down from 6.5 to 5.2. And we say that anytime this happens, it is the second currency here, which is the Ghana cedi, is the one that is causing it to push down like this, right? But if you have the same USD Ghana cedi 6.5, right? And then this pushes up, the rate pushes up from 6.5. Like you wake up tomorrow and they say the rate is now 7.2. What it means is that is the dollar that has become stronger. So that's what I mean by anytime the rate or the market pushes down, it means it's the second currency, in this case, the Ghana cedi, that is strong or is causing the movement. And anytime the market or the rate pushes up, it means it's the first currency or the Ghana cedi that is causing the movement. So that's what I mean here So here we can say A is representing what's the dollar and B is representing the Ghana cedi. So anytime the market, as in AB or the rates goes up, it is A that is causing it. And anytime it goes down, it is B that is causing it. So I hope this makes sense. Right. So the market is traded in pairs. So you can't trade just one currency. You can't just trade the US dollar, or you can't trade just the Ghana cedi. We don't trade, the Ghana cedi is not readily available on the financial market, but it's still traded. But just that we traders like you and I cannot participate in this, but it's also like something that is available to be traded, just that it's not available for us to trade. It's just the banks that can trade it. So let's come back here. So we already learned that the exotic currencies, right, they are paired with the US dollar. So we have the US dollar paired with all of them. So it means that anytime the US dollar is strong, because it's the first currency, the rate of these two currencies will go up, And anytime the second currency or the exotic currencies to the right-hand side here become stronger, then these rates will push down like that. So for these currencies, the major currencies, the pairing is done in a very specific way. You don't have like one currency, just one currency coming first for all of them. You have some of them coming first, but not for all of them, just like that. So this is how the pairing is done. Again, this is not something that you need to keep in mind, but you just need to know it because the pairing is already done. So I believe we went through on our last lesson on trading, we went through watch lists. So watch lists is you put the currency that you be like readily trading, you put them here so that if you want to access them, you just click on them. Right? So the currencies, how they are paired and everything is already on TradingView or a MetaTrader 4. So it's not something that you need to keep in mind. So by just do you know how the pairing is done, and it will help you to learn it faster and also recognize it faster. All right. So we have certain currencies that always take the first position. So we have first and second position. So for the currency that takes the first position, we have the euro. Euro is one of the currencies that always takes the first position. So which means that if euro is paired against any of the remaining, so we have the main currencies, we have 8 of them. If euro is paired with any of them, we are going to have euro being the first one and the other ones will be the second one. So if we're taking euro out, it means we are left with 7 more. So this is how the pairing is going to be: euro Australian dollar, euro Canadian dollar, euro New Zealand dollar, euro US dollar, euro Swiss franc, euro Great British pound, euro, what's the last one? Euro Japanese yen. This is 1, 2, 3, 4, 5, 6, 7. So for euro, anytime you pair euro with any of these currencies, euro will be the first currency, just like we have here. So for euro will be first. So it means anytime euro is strong, any of these pairs of currencies will push up. And anytime euro is strong, it will go down. Because the rule of the first currency is to push the rate of the market up. I hope you still remember. And the second currency is to push the market down. We have another currency that always also takes the first position, and that is the Great British Pound. So the first thing you would ask is, why is the pound the second currency here? So here, when we paired it with the euro, the pound was the second currency. So this is the only exception. The only time that the pound would be the second currency is when it's paired with the euro, because the euro always maintains its first position no matter what. So for the pairing with the pound, you have pound, Australian dollar, pound, Canadian dollar, pound, New Zealand dollar, pound, US dollar, pound, Swiss franc. We've already done euro pound, so we don't need to do, we can't even do pound euro because the euro will always be first when you pair it with a pound. So we are left with pound Japanese yen, pound Japanese yen. So these two pairing, the euro will always be first here, the pound will always be first here, the pound will always be the first. So we have other currencies that will always be the second currencies. The first one is the Japanese yen. So the Japanese yen is always the second currency, which means if you are pairing it against something, it is that's Japanese yen, that's Japanese yen, that's Japanese yen. So we have AUD, Japanese yen, Yuan, Japanese yen, Canadian, Japanese yen, US, Japanese yen, Euro, Japanese yen, pound, yen, Switzerland, Swiss franc, Japanese yen. So there are some of them that I've already retained them. Ideally, I'm not supposed to repeat it. So I already have like euro, Japanese yen here, pound, Japanese yen, but I just repeated them here. It doesn't mean they are different. It's the same thing. Right. So we have another currency that is also always takes the second position. That currency is the Swiss franc. The Swiss franc also always takes the second position. But the only time the Swiss franc would become the first position is when it's paired with the Japanese yen. It means just like we have here. You can see the Swiss franc is the first currency here, and the Japanese yen is the second currency. So we said the Swiss franc would always be the second currency, but the exception is when it is paired with the Japanese yen. Japanese yen will maintain its second position. If you are confused with this, don't worry. The main important thing you need to understand is the first currency moves the market up and the second currency moves the market down. As I said, if you are confused with this is something that is already there. You just need to understand how the arrangement is done. So we have Australia, Swiss franc, New Zealand, Swiss franc, Canadian, Swiss franc, Euro, Swiss franc, US dollar, Swiss franc, rupee, Swiss franc. I don't know what I'm missing. Yeah, so that is it. So we can see that the euro follows a pattern, the pound follows a pattern, the Japanese yen follows a pattern, the Swiss franc also follows a pattern. But what we can see is that We have pairs like Canadian, which does not follow any pattern. Sometimes it's when it's paired with the euro and the pound, it is the second currency. When it is paired with Swiss franc and Canadian, it is the first currency. So those currencies can be first or second depending on what it's paired with. The same applies to US dollar. It is second here, but here it is second here, but here it is first. Same for Australian dollar. First when it's paired with pound and Swiss franc, but second when it is paired with euro and a pound. So those are the other two currencies that those ones don't have like a fixed arrangement. They can be first or second depending on what they are paired with. But let's look at them individually in terms of themselves. What do they bind to? What do they pair with? So we have Australian dollar, New Zealand dollar, Canadian dollar, and then US dollar. These are the remaining ones. So when you pair these two together, it is Australia first, Australia, and then New Zealand. These two countries, they share border. And then Canada and US also share border. This is a USD Canadian dollar. USD Canadian dollar. This is how it's paid. But in terms of between these two, these ones would always be first, and these ones will always be second. So it means you have something like this: Australia, USD, Australia, Canadian. We have New Zealand, USD, and then New Zealand. So this is all the arrangement that you have. So we've already looked at the pairing with the rare currencies or the exotic currency. That is one category of currency. We have what we call major currencies. Major currency is any currency that has the US dollar in it is called a major currency. So for example, this is a major currency: Australia, US dollar; New Zealand, US dollar is a major currency; US dollar, Swiss franc is a major currency; US dollar, Japanese is a major currency; pound, US dollar is a major currency; and then euro, US dollar is a major currency. All right, so everything that we have in green is a major currency, and all the remaining ones are minor currencies. And then we have the exotic currency. So the currency pairs, these are pairs. So they pair with the US dollar inside, and that's the ones I've highlighted in green here, are called major currency pairs. And the ones without the US dollar are called a minor currency pairs. And then we have the exotic. So we have the major, minor, and exotic. So I hope this makes sense. So the last thing, I wanted to do a very long session, but I'm already exhausted. So I'll try, like maybe at the same time tomorrow, I'll try and record the second part of this, but no promise, like it will come soon. I'll try, but I'm not promising. I hope it gets to you guys soon. All right. So another thing that I want to highlight here before we move here is I said that we have two currencies, A and B. A and B, and they are fighting against each other, and they come together to form AB, or the currency pairs. And if A is strong, it will cause AB to push up. AB, AB, or the currency pair. And if B is strong, it will cause AB to move down. There are some terminologies here, but mostly when I'm teaching, I don't want to use those terminologies. You can understand those terminologies later. If you are not ready, it's not about learning terms, it's about understanding what they actually mean and how you can understand them. Later, when you understand what they mean and then you get to know the meaning, then you know, oh, this is how this is called, right? That is my approach to teaching. I'm not really like the person that will teach you like this is this and this is like you know, yeah. But then you can like this first currency. I don't want to even talk about it. It's a brain confusion and all that. So when AB is going up, you buy. And when AB is going down, you sell. You are buying AB and selling AB, not A or B. So, for example, if you have US dollar, what happened? If you have US dollar, Canadian dollar, and US dollar, Canadian dollar is going up, this is same as AB going up. Your decision as a trader is to buy. And if you have USD, Canadian dollar going down, then your decision as a trader is to sell. But then what you need to know from what you've learned is that if USD Canadian dollar is pushing up and you are buying, then you should know that it is the US dollar that is causing this up movement for you to buy. So indirectly, you are buying US dollar Canadian dollar, but you're indirectly buying the US dollar because that is the one that is causing the move. But here, if the US dollar Canadian dollar is pushing down, it means you are selling. And when you are selling the US dollar Canadian dollar. But it also means that you are not buying the US dollar because you are selling USD Canadian dollar. You are selling the US dollar to buy Canadian dollar. I don't want to confuse you, but if you are selling, it means you are not interested in the US dollar. It means you're interested in this. And if you are buying, it means you're interested in the first currency, which is the US dollar. I hope this makes sense. So I'm going to end this here. I'm not going to say tomorrow, but whenever I record the next session, which I hope will be in a couple of days, we'll look at what we call pips, lot size, and then if I have more energy, we'll start looking at markets and candlesticks. Candlesticks. Okay. So enjoy this and give me your feedback. And you can also discuss with your colleagues if you have questions. I hope like some of you would like some of your other colleagues would want to like, I don't know, anyhow you go about it. But if you don't understand, make sure you ask questions. Right? So have a good one.